Good afternoon. Today we are going to go over some of the retirement plan best practices. So for those of you that don't know me, I'm Angela Hall. I do work with Note Advisors and I do run the retirement plan division over for the firm, in addition to being a personal financial planner. So today, if you've attended some of my previous plan sponsor trainings, we've covered some upcoming Secure Act 2.0 regulations that came in, and also just some general best practices. But for today, we're going to elaborate on that a little bit and go over a few more things. And so, for those of you, again, who don't know me, I'm Angela Hall, and this was originally presented on February 9th, 2026. So again, Note Advisors, we do live with the three core values of intimacy, action, and development. You will find that when working with Note Advisors, we really pride ourselves on our relationships with our clients. We are known for being extremely responsive, making sure that we follow through and do what we say we're going to do, but also we help those individuals that we're working with follow through with what they want to do. And as always, we are constantly educating ourselves and making sure that we are on top of any new advancements that may happen in the industry. We also are a fiduciary, and fiduciary is a word that tends to get, kind of tossed around a lot in the industry, but really our main job is to do the right thing for you. So our only job is to work in your best interest. Our objectives for today, we're going to review some terms, roles, and responsibilities. We're going to look at our adoption agreement. We are going to talk about contribution limits that changed for the beginning of this year. Talk about SIPLs because they've had some changes recently. We'll touch upon Secure Act, Secure Choice. We'll talk about why late deferrals matter, testing, some employee engagement, best practices from the Department of Labor, and some miscellaneous. I always try to open with roles and responsibilities. This is really important because in a small business, it tends to have some lines of gray, but it's really good for people to remember who's in charge of what. So your plan sponsor, that is you as an individual who's opening the plan. You are the plan sponsor. So your job is to communicate with employees, to make those deposits and really just make sure the plan's operating properly. For those of you that might have a larger organization that you do use HR professionals, that's going to be the person that oversees your day-to-day operations. They're going to help you with maintaining documents. It might be the person that files the 5500, and they're really in the weeds with your employees and your participants. Many people also have what's called a TPA, or a third-party administrator. This is the organization that works on your testing. They're going to get those things up and running for you. They'll prepare your 5500. They may also assist with some loans and distributions that employees may have. Investment advisor, that would be somebody like Note Advisors, where we help with the investment advice on the plan. So we're helping determine what funds should be in there, making sure that they are still meeting really high credentials, right? We're going to monitor their performance, and we'll also educate and speak to employees and participants. Your record and custodian can be something that goes hand in hand. Sometimes they're broken out, but your record keeper is sometimes referred to as your platform, and they are the actual company that tracks participant accounts from a day-to-day basis. So somebody logs in and they can see that, right, you made a deposit into their retirement account. They're taking record of those actual transactions that happen every day. They're also going to provide those services that are online for people. They're going to have statements, online access, all that like tech that might go on in the background. Custodian is the company that actually holds the money. So again, a lot of times it's the same organization. They can be broken out a little bit differently. And if you are somebody that's using what's called a 316, this is the fiduciary administrator. And really, this is an organization that's an extra layer, so to speak. So they will sign your 5,500 for you. They'll take care of your notices. They do take on a bit more of that fiduciary responsibility off of the employer. So if you're struggling and you're like, wow, this sounds great to me, really feel free to reach out and we can align you with an organization that operates as a 316 or somebody that can provide those services. This is your adoption agreement. So a lot of times I get calls and people are just asking basic questions like, how old does somebody have to be in our plan? How many hours do they have to work? Do we have to have interns? What's the deal with part-timers? So really the adoption agreement is the roadmap for your plan. It's going to have everything in here. Who you are as an organization. Do you offer loans? How many loans can somebody have? Are you able to do a profit share? So all of these things are written in this adoption agreement. If you don't have a copy of your adoption agreement, you should be reaching out either to your TPA, that third-party administrator, or your record keeper asking for a copy of it. It is important to have on file, and it's an easy way just to go back and reference. As most of you probably already know, there have been some plan deferral changes for limits for 2026. We are already into 2026, but I know sometimes it takes a little while for everybody to get caught up with what's going on. So actually for the 401ks, so I'll be in this section here, you can see we did have an increase from last year. So for just a standard contribution limit, it has gone up $1,000. So it's at $24,500. And that catch up has gone up $500 to $8,000. The enhanced catch up, we'll talk about that a little bit more, is listed here. But I think it's also important to look at your simple plans. People out there still have simple plans, and they did have an increase for the normal contribution limit, and that was $500, and the same with the catch up amount, also $500. For simple plan updates, right, just as a quick refresher, who should have a simple, who shouldn't. So for those employers that qualify for a simple, that means you have 100 or fewer employees that earn $5,000 or more annually. So if you've got 200 employees and they're all making at least $5,000, you should no longer be in a simple plan. So, right, simples are meant to be for those smaller employers. Your simple plans, as of 2026, should now all offer a Roth option. So Roth after tax money. So if you have a simple and Roth has not been added to your plan, make sure you reach out to your provider to have this added. Okay. And as we already stated, the 2026 contribution increases, those are great. However, the simple does not qualify for that super catch-up provision. Rolling into the Secure Act 2.0, this is a great picture. It kind of shows you, where do I look, right? So the main crust of what we're talking about still for the Secure Act 2.0 is the Roth catch-up contributions. These went into effect beginning of January 2026. What this is we're looking back at those individuals that made $145,000 or more in 2025. If those individuals are looking to use the catch-up contribution and they make over that $145,000, which honestly can be indexed for 150. So there have been some slight changes there. They are going to have that in a Roth. Okay. So what this means is you want to communicate with your payroll provider and say, hey, I have this many employees. They make over the threshold. Now their catch-ups, because they're over 50, need to be in a Roth. Can you help me make sure I do this correctly? So you do want to, this is going to be more of a payroll function versus a retirement plan function. So you are going to reach out, make sure you have a good payroll provider that understands and is able to work with you. Okay, and so this has gone into effect. They're going to give you kind of into 2026 to really, if you have some kinks you got to work out to do so, this will be heavily restricted and will have to be compliant starting January 1st, 2027. And so if you are wondering, here's just where you can go and make sure that the wages are being accounted for correctly. The next thing that came out of Secure Act 2.0 is the super catch-ups. So the super catch-up is essentially giving people between the ages 60 to 63, so that's 4 years, that they can make a larger contribution. That's going to be, as in 2026, $11,250. So this is a great depiction. It's saying, hey, if you're just doing your regular catch-up, here's what it was a couple of years ago in 2025. Not saying 2026, you fall below in these ages, you're going to be able to do a much more. So if you have individuals that are willing to do that or really want to take advantage of it, this one, you do have to reach out to your plan provider, so that record keeper or your third-party administrator, and say, hey, I just want to make sure that we are, we have this, it's available, and it's going to be administered appropriately. In conjunction with that, similar to the Roth catch-up contributions, you want to make sure it's being allocated appropriately if it is somebody that makes over the allotted amount. It's going to have to be in Roth. So really just two things here. One, are they taking advantage of it? Is it permitted in your plan? And number two, is it being appropriately allocated in payroll? Some things that were covered previously in some of my trainings, just a quick refreshers. Right, a lot of people have individuals in their 70s are still working. Make sure you're asking for an RMD report. So you don't want to miss those people that are supposed to have been taking their required minimum distributions. So this is a report that's readily available, again, through your record keeper or your TPA. So make sure that you're getting it. And really, a lot of times what happens is we have people that retire, they leave their money in their plan, and they forget that they need to take a required distribution. So you really want to make sure that you're capturing that. The second thing is, fortunately, people pass away. You might have beneficiary accounts. They also need to be taking required minimum distributions. The catch-up contributions, we just talked about that. So again, just make sure you've got the super catch-ups. Portability. So this is a big one that's come through too. And I've really seen it being used more in the past year. It did go into effect in 2024 when they increased the limit from 5,000 to 7. So what that means is, maybe you've got some people in your plan, they've moved on to a new opportunity, and they forgot to move their 401k. So those individuals that are between $1,000 and $7,000 really now can be rolled into a default IRA. A lot of the plan providers have been doing a great job with this. It's minimal to no work at all for you as the employer. It does keep your plan clean. So really, I would reach out to, if you're working with an advisor or your platform, to see how you can start to utilize this more. And as we spoke about, the Roth contributions for catch-ups. And this is a big one too, are the part-time employees. So this did go into effect a little ways back. So now this is saying, if you had somebody that's worked for you consistently for 500 hours for 2 consecutive years, they are now going to be eligible to participate in your retirement plan. You don't have to match them, but you do have to give them the option to participate in the plan. So if you're someone that tracks your enrollment for new employees, you may see that list got a little bit longer. As long as you're sending correct hours and you're doing hourly reporting, either with your TPA or your record keeper, right? You're going to see these people that now need to be offered the retirement plan. So don't be surprised if you see this. You can amend your plan document. Perhaps you hire a lot of interns, or you have a lot of part-time employees. But again, if you start to see more people eligible for your plan, this is where it's coming from. New York State Secure Choice has actually passed a few years, many years ago, back in 2022. What this is it's a program saying if you have 10 or more employees, and you're now going to have to start to have a retirement plan for them. Many of the people that are watching this today already have a retirement plan. So that doesn't impact them with having to set up a plan. However, you are required to file an exemption. So even if you have a plan, it's operating great, you do have to log on to the portal and file and certify your exemption. Okay. You will need an access code. On the website, it does say that they've been sent. If you don't have one, there are some steps that you can follow to get one. However, when I tried to log in and do ours, it wasn't yet available. However, I do know some larger organizations where it's already been available. So if you don't have an access code or it won't allow you to do it online, I would suggest that you revisit it. You want to make sure that you get that done. And this is what the site looks like. So when you log on, here's the website, and here's what you will start to fill out. And again, you can see below here, if you don't have the access code, this is going to be where you're going to be able to fill that in. Switching gears to compliance, we're going to talk about some late deferrals. I've seen 2025 was a year for late deferrals, had quite a few come through. So really, I think it's a good refresher that, right, according to the Department of Labor, you are, as a plan sponsor, HR, you need to deposit employees' money as soon as feasible. What that means is if you typically deposit payroll, you need to make that deposit for the 401k within 2 days. And if you do that consistently, that's your deadline. The maximum deadline, it can't be made more than 15 days. Okay, so that's that. For safe harbor plans and the small plans, so this is less than 100 participants, right? They have to be made within 7 days. Okay. You cannot hold on to employee money or make loans. Give yourself a loan with employee money. So really needs to make sure that that money gets in. If there is a late contribution made, perhaps somebody went on vacation, maybe there was an error in the file and you didn't catch it, just be aware there can be a 15% tax, and you're going to have to do a lost earnings calculation. It has gotten a little bit better for doing self-correction and being able to calculate. There's a calculator online for lost earnings, but really you always want to try to avoid this whenever possible. The 5500s will report late deposits. Okay, so the best thing to do, one, try not to do it at all. But number two, if you catch it, be sure to use that self-correction very quickly. It's plan testing time. So right at this point, everybody has ideally turned in their census data. You have perhaps received some testing results and trying to make sense of what they are. So I will say we are not TPAs. We just have some basic knowledge here on what testing is. So really, the first one that you're going to run into and that I find most failures on are the ADP test. So what this means is they're looking at your highly compensated employees and they're saying, are those employees putting a higher percentage rate into the retirement plan than those that are not highly compensated? Right? There's a few calculations that go into this, but if they found that your highly comped are really taking more advantage of the plan and your non-highly comped aren't, you're going to fail the test. So what that means is somebody who is an executive is putting in 20% And the average of your rank and file employees are putting in only 2 or 3, you're going to fail that testing. Similar is the contribution percentage testing. So this is just what's the dollar amount that's going in and for matching contributions. Top heavy, I haven't seen this too much lately. Where I typically see this is with family-owned businesses where you've got multiple family members working at the same location. And so this is saying, do the highly comped or the key employees make up more than 60% of the planned assets? So if that's the case, you'll be called top heavy, and you may, as the employer, be mandated to make a contribution to your non-highly comped. Some other things that go into it is your minimal coverage test, just making sure that everybody is covered by the plan, or the majority. So that would be 70. One way around some of this testing is to do a safe harbor plan. So a safe harbor plan does automatically pass you from the ADP ACP test. And most often you will pass the top heavy test because you got more people contributing at that point. But it does have a mandatory employer match. It can be higher than what some organizations are giving, and it does also have an immediate vesting schedule. So, what are some ways to kind of improve our employer engagement, right? It's something we always want to do to try to help our retirement plans. Research finds that people want to speak to somebody about, their retirement. So really, as the employer, you offering this terrific tool, this great benefit, really should be touted upon. So improve retention. A lot of times, retirement plans help people because, they think this company cares about me. They're helping me save for retirement. Increase productivity. Many people, finance is one of the top stressors. This helps people alleviate some of that stress because, they're putting some money away. They know that they're doing something that's going to help them in the long run. And also company culture, right? Having a solid retirement plan says you're investing in your employees, right? You want them to be able to retire someday, to be able to save. We'll roll into the Department of Labor updates. So recently I listened to a call, that we kind of talked about where the Department of Labor has been going. So for 2026, they are focusing on cybersecurity risks, which is a big one, right? I know 2-point authentication comes through now on a lot of the retirement plan platforms. I found that a lot of people can no longer make changes or trades on the apps that they might use for their retirement plan. So really, the Department of Labor has started to look at cybersecurity. That's not only just the individual accounts, it's going to be you as an employer, is the organization or the platform that you're using able to, secure participants' accounts. So really, you're looking at the level is a person getting into another employee's account, or on a grand level, is the organization that you're using able to protect everyone's accounts, right? Nobody wants that letter in the mail that says, we've had a security breach and unfortunately your accounts have been hacked, right? So you want to make sure you're really doing your due diligence. There's been more focus on mental health benefits, which is terrific, and also the fiduciary breaches related to plan distributions. That's been a big one where somebody logs in, claims to be somebody else, and takes a distribution from the account. So again, those are things that they're really looking for. From a planned level, right, they're looking at forfeitures. If you're not aware of what forfeitures are, forfeitures is the extra money that you might have because somebody wasn't vested all the way, or maybe somebody left and you've already paid for that individual on your plan. That will result in some extra money. And so your adoption agreement, like that we spoke about earlier, does depict how you are supposed to use your forfeitures. So just be aware they are looking at that. Same with benchmarking and fees. You want to make sure that your fees are transparent to your participants. There's really been a shift. We were talking about this today in the office about people understanding how they're paying for their retirement. Where's the money? How much does it cost an individual to participate in a plan? So you want to make that transparent for people. Additionally, you want to make sure that you're going out to the marketplace and either engaging with an advisor like us, perhaps it's a TPA or third party administrator, somebody where you're going out and double checking, right? You want to make sure that your plan is still reasonably priced. Every 3 years, you should have, a benchmarking report for your plan. Another shift that I've seen is rulings have now come on the side of the plan sponsor, right? Once we came out of COVID, more rulings were really on the favor of the participant, but you have seen that shift now to the plan sponsor. Miscellaneous points of interest. So the Trump accounts, I saw a commercial on the Super Bowl that talked about Trump accounts. So if you had a child or going to have a child between January 1st, 2025 and December 31st, 2028, you can establish a Trump account for them. There's particular sites here to go for and to enroll. However, as an employer, if you would like to make a contribution, you are able to do so. However, it does have to make sure that it passes those non-discrimination rules, same ones that we have for plan testing. And so that's going to be happen through cafeteria plans too, right when you're doing other benefits for employees. Claiming tips. Now, a lot of restaurants are going to have retirement plans. Actually sat with somebody today and tips was a big conversation. So when your workers are going to do their taxes, right, it's the $25 deduction. Again, we are not tax preparers here, but a lot of restaurants or, those that might work in daycare or, doggy daycare, hair salons, right? They're all now going to have to participate in some sort of retirement plan, and tips are going to be part of it. The last one here is qualified overtime. Another one that's just come in for tax years 2025. This does impact some of our agricultural community. And it's just saying there can be an income phase out for this. So that is all we have for today. Please, keep checking back. I do like to post different things from time to time. So if you would like to reach out, perhaps get a consultation, here is my contact information. And always be sure to reach out, right? We post new materials on our website. Thank you.